I think they got the memo, Joseph, but we in Europe are, there is such a weird structure over here. So you need to make sure that an Italian governing council member will agree with the Finnish or a Dutch governing council member. That is very complicated to do. And so it's a very consensus-based outcome. Europe is in an extremely tricky situation, if you ask me. So one of my trades, they're public. I am short Italian government bonds. I mean, I'm Italian myself, but honestly, there are no flags when it comes to markets. You have a situation under which inflation expectation in Europe are 3.5% for the next 5 years. Same situation as per the US. Different drivers of these inflationary pressures, but a similar out of control, out of status quo, controllable regime in the chart that we showed before. But at the same time, you have an economy which is weakening much faster than it is in the US because of the Russia-Ukraine situation and because of other idiosyncratic situations that we have in Europe. And then you have an infrastructure under which you have to set one monetary policy for 19 different jurisdictions. So the equilibrium rate for Italy is very different than the equilibrium rate for Germany. And still, the European Central Bank has one rate to set. And so obviously now that they have to set that rate towards a more hawkish level to make sure they can send a signal to the market, the effect is disproportionately bad for the weakest balance sheet components of Europe. Unfortunately, Italy, Greece, Spain, and all the known suspects. And there is no credible way, Joe, under which they can just show up and say, we have a facility, we're going to backstop Italian government bonds. To backstop Italy, Greece, Spain, etc., you need to expand your balance sheet. There is no other credible backstop than to do what the Bank of Japan is doing. This is the line in the sand, 25 basis points. My balance sheet is unlimited. Yours isn't. So if you want to try, it can be unlimited, but you have stop losses and value at risk and other problems. And a risk manager, the Bank of Japan doesn't have a risk manager. They can buy as much as you want. If the ECB would say this is the line in the sand, for Italian government bond spreads, the only way to defend that will be to be ready to expand their balance sheet, to print reserves and buy BTPs, buy Italian government bonds. That will be the least credible thing you can do to fight inflation right now. They're in a corner. It's very tricky.
So actually, just a note, in the US, there are different reserve banks as well. And historically, they would actually have different interest rates, kind of like in Euroland, and to adjust for the different economic situations in each region. And it's ultimately, we evolved over time to be just one interest rate. But it's like you mentioned, it's not necessarily suitable for all regions in the country. But I guess what's most helpful is having a common fiscal authority, being able to redistribute resources. So in that sense, it does make monetary policy a bit easier here than in the Euroland.
Yeah, pretty much. And that makes the European situation more complicated because Italy doesn't have the mandate to try and solve this situation from the fiscal perspective either, because it's bound. Sorry, go ahead.
On one side, though, it's just a one mandate central bank, though. It's just prices. So do you think that they would be willing to, just induce a deeper recession simply just to tame prices? Since it's, that's their mandate is simply in price stability.
Price stability. So what I say that the ECB has a hidden dual mandate. It has a price stability and avoid the euro implosion mandate. The euro implosion, avoiding the euro implosion mandate is basically a geopolitical imperative for Europe. I mean, the European construct is too important to let go. So people are telling me, you need to backstop spreads right now because otherwise the euro will continue to weaken. That is one example of how big of a failure was the last ECB meeting. They try to be hawkish. They try to project that they're going to do something about inflation, project a higher terminal rate. Normally the market will reward this with a higher currency level against other pairs. And the euro has been depreciating since then. It was 107 before the meeting. It's now 104. So, and that goes to say how complicated the situation is in Europe. And the problem as well with Europe, guys, is that we tend to make decisions not in a proactive way, but in a reactive way. So because of this consensus-based mechanism, things have to get really, really, really bad in Europe historically before politicians are closed in a chamber and are, forced to take a decision. And unfortunately, the release valve in this case is Italy, I'm afraid.
And I think it's important to note that in the U.S., quantitative easing serves something of a supplementary function, where the people Treasury does not need quantitative easing in order for the Treasury to sell bonds. If we were to make a salad company, our market company for our salad company that has no revenue would only be 40 million instead of the obvious 40 billion that it needs to be under quantitative easing. But we could still sell tons of bonds. But as you say, Alf, the spreads for Italy, you start to see true stress in sovereign debt if the ECB backs off, which is, the ECB is playing with a higher stakes game. Gentlemen, I want to ask you about quantitative tightening. Well, first of all, actually, Joseph, the FOMC meeting that is going to hear on Wednesday in 2 days, June 15th, everyone was expecting 50 basis points. Now the market is pricing in something like a 30% chance of a 75 basis point hike, a triple hike. And I'm even seeing some, a Bloomberg article about a possible 100 basis point hike. How possible are these scenarios? Because the Federal Reserve has committed through forward guidance, name of the podcast, to a 50 basis point hike on this one, and typically they don't go back on their word, right?
I think there's a 0% chance for a 100 basis point hike. Funny that the way that this works, that some investment bank strategists will say something ridiculous just to have more attention. I'm sure Elf knows as well. It's kind of
Yes.
fun. It's interesting that the market is pricing in some chance of 75. I think that's very, very unlikely. So the way the Fed works is, it's, as you mentioned, Jack, it's through forward guidance, and it's also that the Fed doesn't like to surprise the markets. So Powell has been guiding expectations toward 50 basis points. 50 basis points is what it will be. But more importantly, whether hiking overnight, that's not really where the tightening comes. The tightening comes in how it guides the market forward. So just by doing 50, Powell can also be very hawkish by guiding towards a higher neutral rate, or basically just suggesting that he's going to hike faster and for a longer time. So the way that he would probably do this is he'd probably either I think he would suggest that the neutral rate is higher than he thought it would be. He's been talking about 2.5, 3 as maybe where the neutral rate is. Doesn't really make sense because inflation keeps going higher. When inflation keeps going higher, the neutral nominal rate also goes higher. He could say that, or he could actually be super honest and say, we want to go above neutral because we have a lot of inflation. We need to raise rates to restrictive. So that goes above neutral as well. And he probably, I think, is going to open the possibility of getting there faster. So he can do, let's say, 75, maybe just as out there, putting out the possibility of 100 basis points just to make sure the market is listening to him. So that's, I think, largely in the market to some extent. So the market after the CPI print has been pricing in a more aggressive path. I think the terminal rate, as Alf showed earlier, is just a bit under 4%. I think that's probably not high enough, but the Fed moves slowly, and so I think that'll be a start. And as time goes on, and the Fed figures out that maybe inflation is just not going to go down itself magically, we might be able to see some serious fireworks in the market as the Fed begins to guide towards a terminal rate, maybe above 5%.